All righty. LinkedIn Network. How are you folks doing today? We're so excited that you can join us here. My name is Mitch Benson, and I'm the Franchise Development Coordinator here at A Place at Home, an in-home senior care company in Omaha, Nebraska. Excited to have everybody here. And what we hear a lot from our candidates is obviously a big focus of how to get into business ownership, which is financing your franchise purchase. Multiple ways to get around some capital to help you fund this business for yourself and your family. And so today we're going to talk a little bit about some of those considerations to make when considering this, as well as some options you have available to you. And I'll be asking some questions of our president and co-founder, Mr. Jerod Evanich. How you doing, Jerod?
Hello, doing well, doing fantastic, Mitch. Glad to be here and looking forward to today's LinkedIn Live video.
It's going to be great, and we work here in the development team of A Place at Home. You're the head of it, and we're always on the phones talking to folks who have a lot of opportunity and excitement about buying franchises, about starting a business for themselves. And it's not just a couple dollars, right? This is a big consideration to make, a shift in a career, six-figure and above investment in many cases, right? And so that's heavy. That's a lot to think of. It's very exciting when you get to that area. But we always talk through a few considerations you ought to make before doing that, right? Just kind of the self-check. Are we ready to consider some of these things? So when you think about those, considerations that some candidates have asked you that you've heard over your years of franchise development, what might be some of those considerations that you ought to think of when considering financing your franchise?
Yeah, there's lots of things to consider. I mean, obviously, so many considerations even before you come up with the right franchise for you, right? And then once you find that franchise, and a lot of times, the financial aspect can help gear what that franchise is, right? There's most certainly a difference between opening a Chick-fil-A and that initial investment and opening in A Place at Home or maybe a vending machine company, right? Mm-hmm. Two different ends of the spectrum when we're looking at the financial impact of what it's going to take to start that business. And so, right, knowing your own financial well-being and health is going to be the number one first thing you need to consider. Right? How much money do you have? How much money will you have at time of launch? Right? What is your credit score? In general, if you're going to be getting a loan, you're wanting 680 plus credit score. And that's at the bare minimum, and that at sometimes can even be a deterrent for some lenders if you're right at that very low level of 680. So a lot of times when we talk to people, they may say, I've got $20,000, I've saved up for so long, I can't wait to start a business. My credit score has been creeping upward and onward from 500, and now it's at 600, and I'm ready to start a business. Well, in those conversations, we have to set a realistic expectation of timeline. In that case, the timeline is, hey, you're getting there, right? Your credit score is going up. You're getting to that 680 plus. You got 20,000 in the bank. Congratulations. That's fantastic.
Yeah.
But for most franchising endeavors, you're going to need a little bit more than that. We're looking at Place at Home and a lot of other similar service type brands are about 250,000 net worth. Right. So that's your retirement plans, your IRAs, any kind of 401k, additional income, or what you have in value in your home. Right. So say you own a $300,000 home. You've been paying down on it for the last 8 years, and you now have $200,000 of equity in that home. Fantastic. That can go towards your net worth as well. So, we're looking at that financial history. We're looking at how much money you have currently. Currently, we try to look for roughly $50,000 of liquid cash, right? So people who can come up with that $50,000 for an investment. We'll break down later what that looks like and what that $50,000 requirement is. And that includes a little bit of a safety net. Right. So a lot of times when people are looking at, hey, I've got X numbers of dollars, I'm ready to start a business. Well, sometimes it takes a little time to get that business to cash flow. And once it's cash flowing, to cover your operating expenses. And once it's covering your operating expenses, to cover your income and the amount of money that you need to live. So we need to talk about a safety net. Right? Sometimes that could be built into a loan. Sometimes it may be additional cash that you have on hand. Right? But that initial fund that you need, we're also looking at, down payment. Right? We need some down payment on the loan as well as that safety net. So yeah, Mitch, that's some of those initial considerations in what goes into just that upfront piece as to what do I need to be looking at before I really start deciding what kind of franchise, what kind of investment is going to be there.
Right. And it's just so much exciting work to be done here, but when you can do that, as the steps you've described of, potential candidates who are asking themselves, should I finance my franchise? They're doing these kinds of things of taking a look at, personal credit history and generally speaking, your likelihood of being approved a loan if we were to move towards that, right? Where your assets might be, and a lot of opportunities out there exist to help you kind of determine that and keep track of your sources. A Place at Home tracks this through what we call our personal review form, right? Which has a fundamental personal financial statement that gets folks thinking in this way. So you really put it all out there. And every aspect that you mentioned too, how many incomes do you have in the home? Is it a dual income? Equity in your house? These are all ways that contribute to your net worth and could at one time be leveraged for financing for a franchise, which is excellent, right? And you do all that stuff so that you can start to, see the financial requirements of your franchise, right? What does that initial investment look like for these brands? And if our candidates are here, right, they've likely been doing a lot of this work, a lot of this due diligence. And that initial investment is any number of dollars, any number of ways you could see this, depending on what franchise candidates are looking at. And typically, A Place at Homes, if we're looking at ours, is an initial investment that averages about $110,000. Low side is 80, high side is 150. And that's an element of franchise fee or upfront, dollars to be spent, and then working capital or access to cash as you incur expenses, right?
Yeah,
right.
Absolutely. And, Mitch, with that initial investment, just so everybody has an easy way when you're looking through multiple different brands and trying to decide, okay, what kind of initial investment meets my needs, it's the item 7, right? So you can go to item 7, get a good snapshot of saying, what are those franchise fees? Are there other initial fees, perhaps training fees? Sometimes you see additional marketing fees, right, up front that need to be incurred to be able to launch your business and get the kind of training you need. We don't have any additional training fees. It's kind of all encompassed here at A Place at Home, but just some fees to kind of keep your eye out on. And then, as you mentioned, working capital. When you're looking at the item 7, it's a period of time that we're trying to say how much money is it going to take to cover that period of time. So we're looking at from the day you sign your franchise agreement, you pay your initial franchise fee, and working on into the working capital and the expenses that you're going to incur from the time you sign, launch, and 3 months post-launch, right? So that is the time span that we're looking at.
Absolutely. And measuring, that kind of area with what you intend, right? It's all together. Your financial situation, your cash position, and the initial investment of your chosen franchise will all end up working together, and then you've done so much as a candidate, right? Moving forward with all of these pieces of information, you get to that point where you kind of understand maybe what extra funding you might need. There's lots of reasons why you might use considerable amounts of cash in your business, but there's likely going to be either a need to fill that gap or a strategic decision that you may make as a candidate to fill in some of this stuff, right? And as we've seen this, we've come up against a handful of trusted options that seem to be defaults almost, or not necessarily defaults, but like strong paths for a lot of franchise owners in our industry. What kind of franchise funding options are out there?
Some that Mitch, great question. And there are a lot of ways that you can finance the business, right? So the very first thing that comes to mind is, hey, I could self-finance. I'm sitting on a stack of cash and I'm just ready to spend it and multiply it in a business, right? What better way than to have that money available right now?
Mm.
However, sometimes, that's not all that feasible to have that kind of cash for initial investment. And even if you do, to put it all into one place, perhaps you want to be able to rely on some funding, in which case you can, pay
Mhm.
some at this time, even though interest rates are going up, fairly decent interest rates, and be able to take, that initial, expenditure and increase it exponentially, much higher than the rate of interest that you're going to be paying. So, what we're looking at traditionally, and I'll go into a little bit of each one of these, but the first
Mm.
one I would like to talk about is a lot of times people's biggest assets are their retirement plan, right? So you've
Mm.
got IRAs and 401ks that people have been, spending, not spending, but saving and putting money into as they continue to, from the day they start work out of college. Hopefully, you're contributing and continuing on into, the time that you're ready to use it or retire. One of the programs would be a ROBS program. So you essentially roll over the money that's in your 401k into a loan. And this does have some upsides. It has some drawbacks, and there's an entire conversation and separate, discussion we could have just on this program. But the upside is really there's no down payment. There are some fees to create the structure of the ROBS program. So this is that rollover program. But no down payment, reasonable interest, and you're paying your 401k back, and you're utilizing those funds that you've already contributed, right? They're already yours, and you're not having to take a penalty to use it. So it
Mm.
can have some
Mhm.
awesome upsides, right? But that's not it. There's some other kind of traditional loans, some bank loans that could be available. You can do some more type of traditional term loans. One of my favorite resources most recently that I've been seeing is people unlocking the equity in their home and using a HELOC, right? You can still take advantage of some relatively low interest rates and have a home equity line of credit to be able to fund, as and spend as you need it, money towards starting that business. There's unsecured loans, right? Unsecured loans may be for people that have a little bit less than great credit, still have some cash that they can put towards the business, but it's starting to get in that territory of saying, I can just barely make this work. What do I need to do, right? Or perhaps there's something in their financial history that's stopping them from getting more traditional loans or SBA loans.
Mhm.
And so unsecured loans could be an option. Traditionally, with unsecured loans, although they can be fairly quick and easy accesses to cash, you're going to be paying substantially higher interest rates. Okay, so we've touched on some ROBs, we've touched on some traditional kind of loans, term loans, as well as unsecured loans and HELOCs. But let's also talk about the SBA, right? The Small Business Administration. There's multiple different kinds of SBA loans that you can get, and they're a great way for you to be able to start a business. Relatively, they're going to be lower interest rates than your unsecured, maybe a little higher than your traditional term or HELOC interest rates, but it allows a bank to kind of leverage their risk by having that loan backed by the government, right? By
Mhm.
the SBA. And so that allows them to have a little bit more risk tolerance and say, you know what, we're going to put our chips on your business, right, and bet that you are going to make this successful. And if for some reason you're not, we also have the SBA that is going to help back it. Now, there are more requirements, though, right? You get the government involved. They're not all that risk tolerant, right? They want to make sure they're getting funded. And so there's more stringent qualifications, a longer application process, right? We have examples of SBA loans like your 7A, 504,
Mhm.
your express loans, which most recently sitting in on some roundtables and webinars I hear is not as nearly express as it used to be. But there's definitely different products out there to match that initial investment. And
Mhm.
depending on how much liquid capital you have to infuse into the business, right?
Mhm.
What your credit score is and what the timeline is that you need those funds, there's products that could be right for you.
Mhm. Yeah. There are huge options in multiple ways. I love the upside of, like you mentioned here, in retirement loans, right? It sounds like a huge upside is that's already your money. as an individual, right? That's stuff that you've been investing in yourself and in your retirement, to move to that era of your career with comfort, right? And so yeah, you don't necessarily have to get any interest loans here. This money is already yours, right? And I love that idea of using rollovers for business startups, or ROBS programs, to be able to access that and leverage it against what you plan to do in your business. This sounds like a huge upside to me, right? And it just,
Absolutely.
when you move to a commercial loan, right, working through a bank or something like that, these are the folks who invented loans, right? There's just, it sounds like it's the buffet of options, and you can really work with a lot of angles here to find what's best for you, right? And some folks appreciate having a point of contact in their funding world. Banks can offer that kind of thing, where there's just so many options there. So long as we're ready and have done our considerations before this to understand what your cash position may be, to potentially fund interest payments while your business is building a cash flow. So long as you're ready to do that, then you can see a really solid upside working through commercial banks. And then it's almost
Yep.
like when folks think of business loans, you almost automatically think of the Small Business Administration or SBA loans. There's good reason for that, for what you have mentioned. The government in the United States is backing a lot of these loans, right, to reduce risk for folks, for banks and lenders, right? And so that kind of opportunity really is designed for the types of future business owners that we talk to every day, right? It's for that. There's just options, right? And that's the best part of this whole thing, is that there's a lot of ways to get there. And likely what we see here as an opportunity for the franchisor, whether it be a place at home, if you're looking for non-medical in-home senior care in any number of key markets across the United States, or another franchisor, and you start to consider some funding, right? Our job here is to help you make that pitch to the bank as strong as possible. Right, they're taking a bet on you to make sure that their money is going to get paid back, right? And that's a huge part of what we do with folks, is share with them financial performance representations that we work really hard to get the most value out of anyway, and then B, to share that with all of our candidates through our franchise disclosure document. That, combined with items 5, 6, and 7, give candidates the best way to design what commercial bank loans are going to need from you, what the SBA is going to need from you, which is business plans, right? And you ought to be
Yep.
in those kinds of numbers anyhow, as due diligence really shows you the way to do that. And so as folks are kind of doing it, we wanted to maybe in this call here kind of get to a moment like that, where we might break down in high level terms, right? 10,000-foot view of potentially an example of what that funding might look like, and walk through, an example of somebody who might have that. Jerod, you want to walk us
Yeah.
through maybe an example of considerations to funding?
Yeah. Yeah. Well, again, it really starts with that initial investment. As Mitch said, between items 5, 6, 7, and 19, you're going to be able to not only see that initial investment, you're going to see what kind of upfront fees, ongoing fees, upfront one-time, more capital expenditures, as well as more of your long-term operating expenditures. What are those reoccurring expenses going to be? And so having that information at your fingertips, and again, a franchise system that has spent the time and energy to really dig down into their numbers, are going to be able to provide so much clarity on this for you, to where when you have the FDD in your hands, you should be able to have enough of a picture to really put this together. Right? So starting with that, let's just give an example. We have a business, let's call it a place at home, right? We talked about the initial investment range here, between 85 and roughly 150,000, averaging maybe right around that 110,000. Another consideration, and this is something that I probably should have mentioned when we're talking about those initial considerations, is how much time are you going to spend in the business? Right? How much time and energy and effort can you spend in the business? Because your initial investment can absolutely vary. If you're going to be a full-time, perhaps you have a business partner or a spouse who's also going to devote their time, or perhaps you're going to try to do it part-time and supplement your time with somebody else, right? As well as the potential of you saying, hey, you know what, I'm going to try to be as hands-off as possible, and I'm going to be paying somebody to be able to run the operation. Out of Place at Home, we've seen the best success with owner operators, people who at least put their full time and effort into the business, right? So let's use that as a scenario. The franchise owner is coming to the table. They don't have to completely eliminate and cover the expense of their labor, but perhaps as they start to grow, they're going to be bringing in some administrative help, someone to help grow their business. So let's roughly say the initial investment is $110,000. All right, so $110,000 investment. Again, some of that's going to be paid up front. So depending on your funding options, whether this is a line of credit, right, either through a HELOC or perhaps an SBA-backed line of credit, sometimes you're not paying interest until you use it, which is nice, right, versus the full loan. But a traditional 7A or SBA Express loan perhaps is utilized when you're having a down payment of maybe 20%. Right? If you have a 20% down payment and 20 to 30% down payment, you're going to be able to say, okay, what is my down payment? You know, in this instance, 110,000 at a 20% down payment, that's what, $22,000. Right? So say you have $22,000, we had talked about a $50,000 requirement at a Place at Home as what we want you to have liquid. Right? That gives you $28,000 more cushion for you to kind of put on that safety net. And that safety net is, once I've gotten through my initial expenses, perhaps I didn't allocate enough expenses in my initial investment, or maybe as I'm waiting for that cash flow to ramp up, I can pay myself and I can have enough money to make sure that I'm covering my own personal outside of business expenses, you know, that my family needs to continue. All right, so that's really what that upfront kind of initial split of where that $50,000 comes from. Now that's just kind of the beginning of the puzzle. When you start digging into some of the item 7 numbers, right, there's things in there like marketing expenses. Right? They could be an ongoing marketing expense, something that you're going to be doing into the future. We talked about fees, like a royalty in a franchise. You're going to be paying a royalty. That's going to be ongoing. So in your business plan, you can plan for those things ahead of time. Insurance, right? You're going to need insurance. These kind of things, especially with technology, website, labor, are going to be those ongoing operating expenses that you need to account for. You roll that up into saying, all right, what is that first kind of initial picture of those upfront expenses like franchise fees, office equipment, signage, perhaps a car and a car wrap, an initial package of marketing bundle and swag that you can get out to your market, right? That's that initial expense. Your ongoing expense will get you to the point when you are now able to start seeing a cash flow. In the meantime, you put in your time, your energy, your sweat, and you're starting to build this business. You're bringing on, in our case, clients, right? So you're bringing on clients at the same time, bringing on some caregivers. Good thing is with our business and most service businesses is that you're not paying for the labor until you are actually providing that service, right? So you're covering those expenses. But again, something to most certainly consider in that business plan is being able to cover those upfront labor expenses until you do get those first paychecks in, right? So now you've mapped out what are those ongoing expenses? What does that first year look like? You have this initial investment that you planned on. Do you have enough? Had you factored in enough? If you were only getting $110,000 and you have the ability in an SBA Express loan to get $150,000, do you go for more, right? Do you maybe build in a small salary for you so you can kind of have a little bit of a breather? A lot of times the SBA wants you to take some salary and wants you to be able to have some of that initial income that'll allow you to focus on the business and not be stressed about covering your daily living expenses. And so, Mitch, hopefully I gave you a breakdown. Sometimes I get a little even deeper into some of the business plan stuff. I could talk about it all day and go on to a 5-year projection and all sorts of stuff, including what the business is worth in the future and how we can calculate that. But for today's purposes, anything else that I'm leaving off the table there, Mitch?
It's immensely important information that, you know, every client, every candidate in a prospect or in the position to consider franchises for themselves ought to go through this, right? What you've described here, Jerod, is a great view of what that individual will likely present to a lending institution, right? They need to see it as clearly. The folks who might lend the candidate money need to see it as clearly as the candidate sees it. And we have a great opportunity as franchisors to get our candidates there, right? With quality franchise disclosure document information, like what A Place at Home's franchise owners have enabled us to share, we'll get candidates there so that you have your best possible foot forward when those individuals go to a funding institutions and put up for an application, right? I think it's great.
And Mitch, we talked a lot about expenses. We briefly talked about clients, right? But clients in those billable hours, that equals in our business the revenue. And whether you're selling a widget or you're selling a service, it really helps in a business plan to have some sort of projection as to how many widgets or how many billable hours, how many clients am I going to be able to service over this period of time where they're wanting their loan back, or at least a snapshot into the first, maybe 3 to 5 years of that business. And so again, that information a lot of times can be found in your item 19. So that item 19, those financial projections, not only are going to tell you what those ongoing expenses are, right, and what some of your margins, your gross margins, your net margins are, but it'll also tell you what is that top line revenue and what is to be expected. How many clients does this revenue potentially equal? And what is a decent growth pattern that's going to show that you put some thought process into this business plan, and that there is some, a backbone of a franchise system and other people that are doing it now that have also seen the similar trajectory, right? That allows the SBA to have a higher risk tolerance and say, what, other people have done it. We have proof through an item 19, through their financial disclosure document. We have proof because of other people doing it. We see an owner that has some cash up front, right? They're going to have some skin in the game. They put the thought process into a business plan, and let's take on this loan.
Right. Jerod, I think you hit on it here, and it's a great sentiment potentially to end on, which is the franchising industry provides so much risk mitigation for candidates. There's a reason where we're seeing success at scale. We're seeing a reason why franchise systems persevere through turbulent financial climates, right? It's because there are multiple of us here at A Place at Home, almost a couple dozen of franchise owners here in our system who back up the information that a new client gets to use to potentially, apply for a bank loan, because they get to say that this whole system has this kind of success, right? And that's really why franchising shines, and why we can mitigate some risk. We can offer more peace of mind than independent operation, and give folks who are interested in that, who want to see sort of risks mitigated in this way, who want an added peace of mind as by becoming a part of the system, will see those rewards back to them. And nowhere where it will be more dollar and cents quantified than applying for funding for your business. And for that reason, I really think that what the industry is offered in senior care franchising, what A Place at Home has provided our potential candidates to do, is really special. And we just can't wait to see more and more folks, considering these options, right? Considering what they might do after picking, the franchise that seems like the best fit for them, and then taking that next step. And we're excited to continue here at A Place at Home offering webinars just like this on LinkedIn Live that go a little deeper in some of the programs that we mentioned, like retirement loans, like bank loans, like SBA loans, and talk to some trusted officials who are in that realm and can give us a little bit more context as to what it's like for candidates pursuing these kinds of options. And those will be in the coming weeks. And then we get to take our 2 screen here and make it a 3 screen. We get to bring in a guest, and that's going to be a lot of fun. I just can't wait for it.
It's going to be great. Absolutely. So Mitch, I'll just end on this last kind of thought. The title of today's discussion, should you finance your franchise? The answer is yes. There are very few times in which it ever makes more sense to utilize all your own cash or assets to privately fund a business. There are situations that most certainly could, right? However, usually it makes better sense to use other people's money. And that's where financing comes in and allows you to also mitigate some of your risk in business ownership. So with that, everybody, I have had a good time here. Mitch, appreciate the discussion.
Thank you for your time, Jerod.
Yeah, looking forward to the next one. All right, we're going to bring on some, as Mitch said, some professionals to talk about some of those lending options out there and give you even more information.
Yeah.
Thanks everybody out there watching. We'll see you.
See ya.
All right.